Welcome back to Investing Talk Podcast.
Today we're looking at SentinelOne.
As usual, before we start, subscribe, like, and comment to this video to support the show. So we have a really fascinating disconnect to unpack for you today.
We really do. It's one of those classic cases where market perception is just completely splitting from reality.
Right. To set the stage for you, we are looking at a cybersecurity firm, an AI-native platform to be specific.
And one that has basically achieved perfection on paper.
Exactly. I mean, a 100% perfect threat detection score for 5 consecutive years.
No misses. 0 delays.
None. And they have this massive client base that already includes 35% of the Fortune 500. Customers are highly satisfied. They're spending more money on the platform every single year. And the technology is just visibly displacing legacy competitors left and right.
Yeah, on paper it sounds like an absolute Wall Street darling.
It paints a picture of a company that should be absolutely dominating its lane.
Totally. Those are the kinds of operational metrics you typically see attached to a massive premium in valuation.
Exactly. But here is the core mystery we're unpacking today. Despite those pristine fundamentals, the company's stock price has recently plunged to yearly lows.
Which is wild.
It is. So we're going to break down their technology, examine the bear case currently driving the stock down, and look ahead at the upcoming catalysts that might trigger a reversal.
If you're interested in how enterprise software scales or how market psychology can completely decouple from operational reality, this is a perfect case study.
It really is. What's really compelling about SentinelOne isn't just the stock chart.
Right.
It's the broader evolution of cybersecurity. We're in the middle of a massive transition from manual, human-led threat response to autonomous, AI-driven defense.
And SentinelOne is really at the bleeding edge of that shift, yet the market is pricing in a massive amount of skepticism regarding their near-term trajectory.
We need to figure out why that gap exists.
Absolutely.
Let's kick things off with the fundamentals and the technology mode. SentinelOne is currently a major player in the endpoint protection space.
Right. They hold a 9.47% market share,
making them the 4th largest player in a highly fragmented field of 37 different competitors.
37 competitors is a fiercely crowded market. But SentinelOne's flagship offering approaches the problem differently.
The Singularity platform.
Yes. The Singularity platform, it's an all-in-one agent. You see, in the past, companies would have entirely separate tools for endpoint protection, detection and response, cloud security, event management.
They were clunky.
Super clunky. And more importantly, they didn't talk to each other.
Right. And that creates blind spots.
Huge blind spots.
SentinelOne essentially collapses all of that. Endpoint protection, detection and response, extended detection, and AI security information management. It collapses it all into a single AI-powered brain.
Exactly. You don't have 4 different software agents bogging down a laptop or a server. You have one unified system.
It reminds me a bit of the Apple ecosystem effect.
Oh, that's a good comparison.
Once you have all your devices seamlessly communicating, introducing a third-party tool just breaks the flow.
That consolidation is their primary competitive moat. Rival companies often require multiple software agents running simultaneously,
which slows down processing power.
Yep. And it creates those exact blind spots you just mentioned. SentinelOne does all of this within a single agent, utilizing proprietary patents in behavioral AI.
But where this goes from an interesting architectural choice to an undeniable advantage is in the performance data.
The MITRE, ATT, and CK evaluations.
Yes. This is the data point that really caught my attention.
It's the gold standard.
It is. For you listening, the MITRE evaluations are basically the proving ground for testing defenses against real-world, nation-state level hacking techniques.
And SentinelOne has achieved 100% accuracy with 0 delays in those evaluations for 5 consecutive years.
5 years of perfect scores against the most sophisticated simulated attacks on the planet.
It's kind of hard to overstate how impressive that is.
Yeah. And when you look at how they stack up against the rest of those 37 competitors, the gap is massive.
Huge.
SentinelOne produces 88% less noise, detects threats 63% faster, and has a 55% lower mean time to respond, or MTTR.
We really need to pause on that MTTR metric, because mean time to respond is not just a technical bragging right.
Right.
It is a massive financial lever. If you're a chief information security officer, noise in your system.
False alarms.
Exactly, false alarms. That is your biggest enemy. If your system flags every unusual login as a critical threat, you get alert fatigue.
Your IT team spends thousands of hours chasing ghosts.
While the real threat slips right through.
So by producing 88% less noise, they're essentially giving a company its IT department back.
Precisely. In the AI era, security is no longer just a human resource problem. It's a math problem.
Right.
When a ransomware attack can encrypt a company's entire database in minutes, human response times are completely useless.
You need machine speed responses to machine speed attacks.
A 55% lower MTTR means the AI is doing the heavy lifting of autonomous threat resolution. It finds the fire, and it puts it out without waiting for human analysts to approve the action.
And that technological superiority feeds directly into their go-to-market strategy, the classic land and expand model.
Right. They get their foot in the door with basic endpoint protection.
And the software proves so effective that companies just keep adding modules.
The numbers definitely back this up. 40% of their enterprise customers are now using at least 3 of their modules,
And 20% are using 4 or more.
which creates incredibly high switching costs. Think about it. If a Fortune 500 company is using SentinelOne to secure their servers, their cloud architecture, and their identity management,
Ripping all of that out to switch to a legacy incumbent is an absolute logistical nightmare.
it creates a very sticky customer base.
Okay, let me push back on that a bit. Moving from the tech side over to the financials and scale. If their tech is that sticky, it has to show up in the financials.
It does.
Let's look at their net revenue retention. SentinelOne's NRR sits at 115%.
Which is fantastic.
Now, 115% is undeniably strong. It means existing customers are staying and spending 15% more year over year.
Right.
But in a tight macroeconomic environment where CFOs are actively looking to slash software budgets, how sustainable is that? Can they actually keep upselling these extra modules when enterprise budgets are shrinking?
It's a valid question, but you have to look at the return on investment. The data shows that customers using SentinelOne demonstrate an ROI of up to 338% over 3 years.
338%.
Yeah. When you consolidate 4 or 5 legacy tools into a single Singularity subscription, you are often actually saving money.
Because you're reducing licensing fees across multiple vendors.
Exactly. And you're drastically reducing the manual IT labor required to manage them.
So the pitch to a CFO isn't just buy better security. It's buy this, and we can cancel 3 other contracts.
Spot on. And they are executing this at an impressive scale. We're talking about nearly 13,000 customers.
Which includes 35% of the Fortune 500.
And within that client base, they boast a 98% customer satisfaction rate.
In complex enterprise software, maintaining a 98% satisfaction rate at that scale is exceptionally rare.
It really is.
It also seems like they aren't just hoarding the cash they generate from these clients. They're aggressively reinvesting free cash flow into strategic growth areas.
Right. They're pushing hard into Purple AI.
Which is their AI-driven security operations center tool.
And Singularity MDR. Plus, they recently acquired PingSafe to bolster their cloud security offerings.
Cloud security is arguably the most critical expansion vector right now.
Oh, absolutely. As companies migrate completely away from on-premise servers, the perimeter they need to defend has shifted entirely to the cloud.
So by buying PingSafe, SentinelOne is ensuring they own that entire unified security perimeter. They're building the exact puzzle pieces their clients need.
Which brings us right into the sentiment and technicals, because there is a massive disconnect here.
A glaring one.
If you just tuned in, you'd assume this stock is flying high. Incredible tech, perfect threat detection, massive customer ROI.
Sticky revenue.
Yeah, but the reality is a year-to-date plunge. The stock is sitting at yearly lows.
Let's look at the bear case, because recent analyst price target cuts tell a completely different story from the operational metrics.
The market sentiment is undeniably skeptical right now. We saw Barclays maintain an equal weight rating, but slash their price target to $16.
And around the same time, Wells Fargo initiated coverage with an equal weight rating and a $13 price target.
Why the sudden gloom?
Well, the overarching narrative driving this sell-off seems to be fears of a broader growth slowdown.
And execution risks in enterprise sales cycles.
Right. Basically, investors are worried that massive Fortune 500 companies are going to pump the brakes on signing multi-million-dollar software upgrades.
And that is a legitimate concern for the entire software sector. Enterprise sales cycles are notoriously slow.
They can take 9 to 12 months easily.
When you are asking a major corporation to rip out their legacy vendor and adopt a brand new platform-wide AI system, that isn't a decision made by a mid-level IT manager.
That requires board-level approval, It's a
Yeah.
massive capital expenditure.
Exactly. So the bears are arguing that while SentinelOne's technology is demonstrably better, the actual execution of closing these massive deals is going to drag out.
And if deals get pushed from Q3 to Q4 or into the next fiscal year, near-term revenue growth takes a hit.
The market hates uncertainty, and long sales cycles breed uncertainty.
But the bull case counter-argument here is fascinating, mostly because of how aggressively the stock has been punished.
Right.
While the surface-level sentiment is neutral to slightly bearish, the underlying valuation of the company has become incredibly cheap. The stock is currently trading at a multiple of less than 4 times sales.
Trading under 4 times sales for a software company with 115% net revenue retention and a 98% customer satisfaction rate is highly irregular.
Very.
Typically, you only see that kind of multiple compression when a company is in terminal decline or when their core product has been commoditized.
And SentinelOne is doing the exact opposite. They're rapidly expanding their AI product suite and taking market share from incumbents.
Which raises a critical question. Has the market completely overreacted to short-term sales cycle fears?
Blinding itself to the long-term structural advantages.
Some analysts certainly think so. Oppenheimer is maintaining an outperform rating with a $20 price target, completely bucking the trend from Barclays and Wells Fargo.
And other market analyses are pointing out that these yearly lows signal severely oversold conditions. They're basically screaming that the stock is highly undervalued.
If you really want to understand where the smart money is leaning, you have to look past the analyst notes and look at the institutional flow.
Yes, the late February options activity.
If you look at the market data around February 25th, there were massive institutional alerts triggered.
We are talking about multi-million-dollar trades that retail investors simply don't make.
The implication is clear. While retail investors might be panicking over headline price target cuts, institutional investors,
Hedge funds, asset managers.
right, they are quietly using this massive plunge to accumulate shares. They are looking at the 100% MITR scores. They see the continued displacement of legacy vendors in the Fortune 100, and they are buying the dip.
They are playing the long game while the broader market panics over short-term execution timelines.
It's a textbook value play.
But as we know, a stock can stay undervalued for a long time unless there is a catalyst to wake the market up.
Fortunately, there is a very clear horizon of upcoming events.
So let's pivot to the risks and the upcoming catalysts over the next few months that could shift the narrative.
The most immediate and structural catalyst is the executive leadership change. Sonali Parekh, taking over as the new chief financial officer on March 24th, is a massive signal to the market.
Sometimes a CFO change can spook investors. It can signal internal chaos.
But in this case, it looks like a very deliberate strategic pivot.
She's being brought in to usher in the next chapter of growth and profitability.
Every high-growth tech company goes through this life cycle. Phase 1 is growth at all costs. Capture market share, build the absolute best technology, and don't worry about the bottom line.
But eventually, Wall Street demands a pivot. You have to prove that your massive revenue engine can actually generate profit.
Bringing in a CFO specifically tasked with driving that profitability inflection point tells the market that SentinelOne believes it has finally achieved the scale necessary to start generating serious earnings.
And speaking of earnings, their fiscal Q4 report is imminent. The setup here is highly asymmetric.
They are heading into these earnings at yearly lows.
The expectations have been completely washed out.
Exactly. The bar is practically on the floor. When a stock is priced for perfection, trading at 20 times sales, even a fantastic earnings report can trigger a sell-off if it misses one minor metric.
But when you're trading at under 4 times sales, swimming in bearish sentiment, it doesn't take much to surprise the upside.
Even a modest beat, coupled with slightly optimistic forward guidance for fiscal year 27, could trigger a massive rally.
The market is just waiting for a reason to buy back in.
We also can't ignore the broader macro environment.
Right.
Over the last few months, we've seen a pretty distinct sector rotation. Capital has been flowing out of high-flying, consumer-facing AI software.
Perhaps due to fears that the hype outpaced the actual revenue models.
But that capital didn't just evaporate. It's rotating into AI infrastructure.
Right.
And if you think about it, cybersecurity is the ultimate digital infrastructure.
You absolutely cannot safely deploy AI in a massive enterprise environment without an AI-native security perimeter to protect it.
SentinelOne is positioned perfectly to catch that rotating capital as investors look for the picks and shovels of the AI boom.
Furthermore, they recently unlocked a massive, highly lucrative new market segment. They achieved FedRAMP High authorization.
Let's expand on why that's so critical right now. FedRAMP is the government's standardized approach to security for cloud products.
And the high designation is the most stringent level.
It requires passing the most exhaustive security audits imaginable. By securing that authorization, SentinelOne can now bid on and win the most sensitive government contracts available.
And government contracts are the holy grail of sticky revenue.
Once the Department of Defense or a major federal agency integrates your security platform, they are not switching vendors a year later to save a few pennies.
It is incredibly reliable, long-term revenue, which perfectly counters the bear case.
Yes.
If the market is worried about long enterprise sales cycles in the private sector, winning massive locked-in government contracts provides a massive revenue buffer.
It stabilizes the balance sheet while those Fortune 500 deals slowly work their way through board approvals.
When you synthesize all of these factors, a very clear picture emerges. The unmatched threat detection scores, the 115% net revenue retention,
The deep undervaluation.
the pivot to profitability under a new CFO, and the unlocking of federal revenue streams.
It really does paint a clear picture. Despite the grim price action we've seen on the charts recently, the underlying analysis assigns SentinelOne an impressive bullish score of 8 out of 10.
It really frames the company as a strong multi-year hold, especially as we head into these imminent catalysts.
The disconnect we've explored today is fundamentally a timing mismatch. The market is hyper-focused on the risks of the next quarter.
While the operational reality points to a company that is structurally dominating its sector and laying the groundwork for massive profitable scale over the next decade.
And that is the biggest takeaway for you today. Stock charts and daily market sentiment often tell a completely different story than the operational reality of a business.
A stock sitting at yearly lows doesn't automatically mean the company is failing.
Sometimes it just means the market has temporarily lost sight of perfect threat detection scores, massive enterprise adoption, and quiet institutional accumulation.
It's a reminder that critical thinking is your best asset. You have to look past the headline price targets and examine the fundamentals.
Are customers staying? Yes. Are they spending more? Yes. Is the technology demonstrably faster and more effective than the legacy alternatives?
Yes, which leaves us with one final big picture thought for you to mull over. We've talked a lot about SentinelOne's autonomous AI-driven response capabilities.
Right.
As we move into an era where cyber attacks themselves are entirely driven by artificial intelligence.
Where malware can adapt and mutate in milliseconds.
Exactly. Human reaction times become mathematically obsolete.
That is an undeniable reality. A human analyst, no matter how skilled, simply cannot read the logs, identify the anomaly, and quarantine a server fast enough to stop an AI-driven ransomware attack.
The battle is now algorithm versus algorithm. So here's the provocative thought. Will autonomous AI-native platforms like Singularity soon transition from being an optional enterprise upgrade to an absolute legally mandated baseline for global corporations?
Think about it. If a major bank or a hospital network is breached and data is stolen because they relied on human-led security instead of autonomous AI,
Will courts and regulators eventually deem that negligence?
are we witnessing the beginning of the end for human-led cybersecurity response entirely?
If the answer to that is yes, and I suspect it is, then the total addressable market for companies possessing this specific AI architecture is vastly larger than current Wall Street models are pricing in.
It's a fascinating concept, and it totally changes how you look at the future of digital defense and the companies building it.
Keep questioning the consensus, keep looking at the underlying data, and remember to subscribe, like, and comment to this video to support the show. We will catch you next time.